Hello and welcome to this video featuring yours truly, Mike Wade and Tom's Tools. I'm the guy on the bottom there. The disclaimer is stock and options trading has large potential rewards, but also large potential risk. You must be aware of these risks and be willing to accept them in order to invest in the stock and options market. Don't trade money you cannot afford to lose. You know all of that. You also know I'm not an investment advisor. Please don't construe anything I'm about to share with you as advice. And please note that all prices are in US dollars unless noted otherwise. As you know, please pause the recording and read the balance of the disclaimer at your leisure. All right, so today we're going to talk about one of Tom's rankers, and we're going to get into the world of average true range. This is one of many indicators that was developed by J. Wells Wilder back in the mid-1900s or so. And this particular indicator actually measures the average true range of a stock. So think about it. Stocks behave in a certain fashion. They move around a certain amount on average. And then what we can do with this ranker is, and really conceptually what we're doing with this ranker is we're looking to see when a stock breaks out of its average true range, where in other words, the current range of the stock, the current daily range of the stock actually exceeds the average true range of the stock. So the average true range is a formula, and you don't need to know the formula, but just so for your information, the first thing we calculate is the true range of the stock, which is really a very slick and simple calculation that considers the highest of either the current high minus yesterday's close or the current low minus yesterday's close. So what's happened between yesterday's close and the total movement of today? So we want to find the largest range possible and use that as the true range of the stock. And then we have the current high minus the current low. So maybe today the actual range of the stock from the high to the low is higher than what happened between today and yesterday. So that's really what the true range is all about. And then we calculate the average true range with that formula there. But essentially what that's all about is taking a look at the prior 13 days of ATR and then adding the current trading range, the TR, and dividing by 14. So this is a 14-day smooth, accurate moving average of what the stock normally does. So what can we do with that? All right, so I call this the spit the dummy strategy. And I'll talk more about that in a minute. So basically, what this means is that we can run scans and find when the current trading range, today's range, is above the average true range. And that indicates a possible move present in the stock in question. All right, so here's an example of on Garmin. This is a recent slide, and it shows on the bottom of the screen, you can see here we have two colored lines. The blue line is the average true range, and then the gray line is the daily range, the true range, let's call it. And so essentially what happens is when the gray line pops above the blue line, that's an indication that something's up. The stock is crying. The stock has made an unusual move. So look here, on this particular day when we had that big spike up in true range, well above the average range, the stock gapped down and continued to move down. The same thing happened here. The stock gapped up. It moved a lot bigger than normal, and that led to a sort of a flat trade. There wasn't much happening there. We didn't make any money there. And then it happened here. We had an up range, and here a down range. We made money there, and we made money here. And then most recently, there's been a pop up, and I'll look at that one as an example. So essentially, the way the system works is on the day that the true range pops up above the average range, that's a sign that the stock is screaming, has made a move. And what we do is on the day of the move, in this case a down move as an example, we would continue to take the stock down. All right, so that's how it works. Think of it this way. Think of the British saying the baby spit the dummy. All right, so what does that mean? Well, it means the baby got upset and was pacified and then spit out the pacifier. So that's one real world way to think of this strategy. So we're looking for stocks that have spit the dummy and ready to make a move. So that is what we are up to. Let's pop into the software and let me show you how to find these things. I'm going to go into Tom's Tools. You go to Stocks, Stock Rankers, and Average True Range. All right, notice I'm back tested on 220 up here. I'm going to run this scanner against the S&P 500. There's different settings here. You can look for the highest average true range, and what that's going to uncover are the stocks where the true range may have actually be setting a high or actually busting out above the average range. And then we have, we can also normalize that by comparing it to standard deviation. So that's also interesting. We can also look for flat stocks that aren't doing much, and the ATR is just really, really flat. Why would we do that? Well, we might want to run calendar spreads or some sideways strategy that profits if the stock does nothing. So that's can also be done with this scanner. But for me, I'm looking for spit the baby stocks, spit the dummy stocks, stocks that are ready to break. So I'm going to click highest ATR and then hit my search button. And then within a matter of seconds, the scanner is going to come back and present to us in order the stocks where the average true range is at the highest that has been over the past 14 days. And you can see here, this first one on Garmin, we have the stock name, the company name, the stock symbol, chart, pick, news, all the basic stuff, the stock close, stock volume, the high ATR over 14 days, the low ATR, and then we have the latest ATR over 14 days, and then where this thing stands, where the current ATR stands over its last 14 days. So you can see here on Garmin that this scanner is telling us that Garmin has spit the dummy. So let's look at a chart, click chart, that'll pop you right over here, and notice that this scanner using ATR, we're able to discover that Garmin has just popped up. Take a look at the chart below, the ATR chart, and you can see, again, true range is gray, average true range blue, and you can see, you can't quite see it, but this true range goes up to 1233 right there, which is right up here, and you can't quite see it on the chart, but needless to say, the stock spit the dummy and looks poised for a move to the upside based on this logic. If I take it to the latest day, 8 days later, and you can see that in fact the stock did move up. So that's one way to pick direction and have the stock tell us and announce to us that it's ready to make a move. All right, now, so that's what we've just covered. We just covered finding spit the dummy stocks with the ATR ranker. And then now I want to talk about how to, just a summary, and then how to use options strategies to profit. So again, what you do is you go into the average true range ranker, you click S&P 500, you select highest ATR, you click search, and then you take a look at the individual charts that are on the top of the list. Now, what can you do with these? So you have a stock that seems poised for a move to the upside or the downside. Some basic option strategies to consider are long calls and puts, just the basics. If you're going to use long calls or puts, use out-of-the-money options, 1 or 2 strikes out of the money, and buy 60 to 90-day options. If you want to spread it, if the options are too expensive, they cost too much, you can spread. If implied volatility is too elevated, you can also spread. And what you want to do there is buy a long call spread or a long put spread, depending on your direction. And you want to use out-of-the-money options. And you can do shorter-term options because we're spreading. Use 30 to 60-day options. And then lastly, if you're a credit spread trader, this is an excellent strategy for credit spreads. You can sell out-of-the-money call and put credit spreads with less than 45 days to expiration. All right, there you have it. That's the video for this week, and I will see you all next week. Thanks a lot for watching.